Hello everyone, Clifford Bennett, Chief Economist at ACY Securities, and stocks are really starting to fall away. It's starting to get just a little bit ugly over the last 24 to 48 to 72 hours, but the rollover occurred several days ago, but it's certainly gathering pace to the downside now. This pace has been hastened by, of course, the Bank of England hiking rates by full 50 points yesterday, as did Norway. I've been saying a little bit earlier today about how this whole Western central bank mentality is really missing the point, and they're not understanding that enough is enough. Basically, yes, interest rates needed to be raised. They were slow to raise them in the first place. I was the one who was arguing when everyone else said, isn't this great? We've got near zero interest rates. I was one of the only economists, very few, I actually don't know of any others, who was arguing we should be raising interest rates now before inflation gets away, and then the central bank will have to aggressively hike interest rates in a year or two's time. And that's exactly what's happened. So none of this is hindsight for me. I was saying it in real time. That's the big error. And now the second big error is to have to hike aggressively. And now a third big error is to hike too far. Basically, inflation is a very different creature now, and it's had enough of an interest rate hit, not any further interest rate hit. It's like if you're watering a plant. Once the pot's full of water, it doesn't matter how much more water you add, you're not going to get a different outcome. So with interest rates at the moment, they're at full capacity in terms of their impact on inflation. Any further interest rate hikes, all they do is, yes, slow the economy, but they're not really having an impact on inflation, because inflation is going to subside all of its own accord on this occasion, because it's a different form of inflation to what we had last century. And we don't need last century's policies and thinking on the matter. We need contemporary, look out the window, real world economic, construction of how do we deal with the current issues, what forms them. And, it isn't an overheating economy in the US or the UK that's driving inflation. Therefore, hitting that economy with further interest rate hikes just ensures an even deeper and more prolonged recession and slowdown period, which could now extend for a further 1 to 3 years. Imagine that. Imagine another 3 years of sluggish economic growth out of the United States and Europe, and perhaps in Australia too, because the central banks are simply using a simplistic approach. That is, oh yes, this worked in the 70s and the 80s, so we'll do it now. We'll just raise interest rates through the roof and that'll stop inflation. Inflation is going to roll over of its own accord. We've already reached the limit, the capacity of real effect of just raising rates. And policymakers need to understand they just need to step back, because this form of inflation is going to be persistent, particularly at the core level, but it's not going to be defeated by any further rate hikes. Of course, at some point, all these central bankers, in a year's time, 2 years' time, are going to go, look, we had to raise rates because we needed to defeat inflation, and inflation is lower now. Yes, but it would have been anyway, is my point. And all you're doing is making the economic slowdown twice as intense and prolonged as it needed to be to defeat inflation. So and it's really a Western economic problem. A lot of the central banks of Asia and Central America, for instance, and elsewhere in the world, they've understood the nuances of this new global economy and the nature of this new inflation wave that we have found ourselves all swimming in, treading water in at best. And they haven't done what these Western economies have done, these Western central banks have done. It is a cultural groupthink amongst the Western central bankers to just put on the blindfolds. Inflation's high, keep hitting it with the hammer, the sledgehammer, the mallet of higher interest rates. It has to stop. And I think it's time that a whole lot of economists began to stand up and say, in the face of these central bankers, you don't know what you're talking about. And they really don't, because I hear it so often. Oh, but it's the Reserve Bank. Oh, but it's the Federal Reserve. Oh, but it's the IMF. They know what they're talking about. No, they get it wrong all the time. In fact, they get it wrong more often than they get it right. And in Australia, that's because we haven't had a robust debate about the performance of our Reserve Bank, because the Reserve Bank's done everything it could to shut down that debate, that very debate. So we do need to start yelling from the rooftops again. Enough is enough. Stop the interest rate hikes. They're just going to drive the economies, the Western economies, further into the ground. I think probably we've reached the tipping point now where even if they cut rates, and I always forecast there's not going to be any interest rate cuts, and that's been perfectly correct and went in the face of market sentiment, but was perfectly correct. But even if they did begin cutting interest rates, and they're not, by the way, even if they did, it's probably too late, is the point I'm trying to make, to save the Western economies from a sustained downturn period. Now, it may not be as bad as Japan's lost decade, but it's going to be another, I think 1 year is too optimistic. It's going to be a 1 to 3 year period of below par economic performance, which virtually no business or consumer or investor is positioned for. And that's why be careful of this stock market decline. If it continues to gather speed into next week, this could be the big one, which I thought would happen a lot earlier. I was warning of, only to help people play their investment portfolios appropriately in a defensive way, just trying to help, not wanting the end of the world to happen, but if it's going to happen, it's better to know in advance that it's coming. And so it's not the end of the world, but it is a significant slow and elongated economic slowdown period that you have to put that into your thinking. Now, if you're running a business, or if you're a trader and investor, when things are difficult, that's when the greatest opportunity of gaining market share or extensive profits, they're the big opportunities. I mean, the big opportunities in markets occur when the market is wrong, because it has to price out the wrong view and then begin to price in the correct view. So it's you get these huge price shifts over expanded periods of time. And that's what I think we could be in for here with the US equity market and the Australian equity market. Now, the buyers will be back. They've been back a little bit on the day, and they were back at the close in New York. They may try again in New York morning trading session, but if you see the market closing roughly where it is now or lower for the Friday close, it's going to shape up for a very difficult and challenging week ahead for equity markets. Just one quick point on the US dollar. I've been saying for some time things could go very ugly for the United States, yet the US dollar could still rally in the medium term. My long-term view is the US dollar is going a lot lower, 10 to 15% lower, but that might be over 3 to 5 years. For the moment, if there is a real equity market crisis developing here, and it's not certain that it is, but it certainly looks that way, if there is a real stock market crisis developing here, a lot of American fund managers and corporations, some of the biggest in the world, might hit the panic button and bring their funds home from offshore. There may be some investors around the world who say to themselves, well, even if it all goes wrong, if I have my money in one of those top few big banks in New York, they're guaranteed by the US government. My deposits, anyone in the world can have their deposits guaranteed by the US government by moving their funds into a US bank account with the big ones. So those sorts of processes, and of course, I think the bond market's going to get sold off along with the equity market, which means the yields will be higher, and that could cause some attraction to the US dollar as well. Plus, there's been a lot of positioning, long euro, long Australian dollars of late, that needs to be unwound, and that's why you're seeing some fast price action there. So just be wary, and it's a very dicey at the moment. Markets are very dicey, to be sure. It's a more difficult call on the US dollar and the Aussie dollar and the euro, but sterling, for instance, had a 50-point rate hike and fell back. I think sterling's probably a sell because all the good news, at least there is no good news except that there were interest rate hikes, and that seems to be fully priced. And the UK economy is probably headed for recession as well. So I would tend to be very bearish sterling. I would tend to be a little bit bullish US dollar for those reasons I mentioned. Panic button in the US, bringing funds home, some safe haven flows from offshore, and the yield will be a little bit higher, although I wouldn't be buying the US dollar on that basis at the moment because long term it has such severe structural problems. I hope this helps. It sounds negative. No, it isn't. It's positively looking at what's going on and recognizing that we can all deal with this downside, but we have to play defense with our investment portfolios. If markets were to tick up here, suddenly turn around, if Friday's a booming, the New York session tonight is a booming session and Monday, Tuesday follow through, we get out of jail. But at the moment, it's not looking that way. At the moment, it's looking like any rally will be sold. Be very careful about all aspects. Have a big strategic rethink of your investment portfolio and be proactive about managing your exposures and the opportunities that are very much in play. Thanks very much.